Hello and welcome. This is Elliot Leffler. I'm the Executive Marketing Manager for Darden Business Publishing, and I'm joined by Professor Michael Schill. Thank you for joining us today. We are very excited to introduce to you a simulation that Michael's been working on for, about 4 years now, is that right?
That's right, yeah.
And we use this bond trader simulation in our core finance course to introduce capital markets. And I'm going to let Michael take it from here. I'll be able to come back and join you to answer any questions as we're wrapping up.
Excellent. Thank you, Elliot. Appreciate the introduction. I want to thank you all for joining me this afternoon, and appreciate the help of Elliot and certainly David Engler, who's the developer in this simulation. And we're pretty excited about this. And let me start out by talking about why the simulation. So we observed a couple of things. So one was that the introductory finance math that's common for introductory courses in finance, that it wasn't really engaging. It was kind of a turnoff. That going through bond math, time value of money, grinding through a whole series of homework problems was an introduction to finance. We thought we could do better than that. And so the alternative to the homework problem solution is a competitive trading simulation, where students are introduced to a trading market where they're trading simple IOUs. And in that market, they're able to understand all of these principles in a context that keeps them engaged in why they're learning these things like time value of money and the bond math and the yield curve and things like that. Another why was this notion that that our students didn't get markets, that things that are so fundamental to finance, like understanding how prices are formed and notions of market efficiency and an understanding of the required return and why that's required and what's going on in the investor's mind that gets them to that number. Those are core concepts that weren't resonating with the students, and we thought we could do better. So getting them in a market, the simulated market, where they're seeing those prices come out of their own behavior, and they're seeing alternative securities and trading off those securities in that competitive setting helps them understand, the mind of the investor and how these outcomes are coming about. When they see information come out and they're seeing their own behavior and the behavior of their peers creating the market efficiency that we talk about, rather than just walking them through that theoretically. So those are the two big, I think, whys of this, is trying to provide a more engaging introduction to the fundamental math and helping students get it, get markets and how they work. So I'm going to run through a little presentation. I'll give you a little orientation to this, and then we're actually going to do a little bit of trading here against those that are participating here. So let me see how this. All right. So the game, right? I'm going to talk particularly about scenario A. There are multiple scenarios of this, but this will be a good introduction to how this works. Are we all, I assume we're seeing? Yeah. So, so in scenario A, each participant, for all the scenarios, each participant begins in January 2019 with $1 million in their investment portfolio. The entire portfolio begins in a cash account, and the objective is to have the highest amount in your investment portfolio by December 2019. There are two investment opportunities. The cash account earns an interest rate that varies week to week, and a credible analyst will provide forecasts of expected interest rates over the 1-year trading period. And the price of the cash is always $100. The alternative security is the 1-year bond. So we'll call that December 19. And December 19 pays a certain $100 at the end of December 2019. There's no default risk in this bond. And the price of that bond is going to be determined by the aggregate buy and sell orders of the student and the randomized traders in the market. So that price is highly uncertain, totally determined by supply and demand in the marketplace. So the interface looks somewhat like this. So there's a number of different panels. So there's a news panel that you see here, and news will come in this first simulation. There won't be any news. The only thing relevant there will be the week that we're in. So currently here in January 8th, 2019. And then here in the portfolio window, we have the amount of cash. So in this case, there is $1 million in cash. And the interest rate for the week is 4.35% on that cash. And then the alternative security is December 19, and that is trading at 94.69 or 94.79 ask. So if one were to buy it, one could buy it at 94.79. In order to do that, you would put in an order, let's say for 1,000 bonds, into that buy order window, and then click on buy. And that order would move through pending and then eventually be executed at 94.79. As one is looking about this, one's trading off, okay, there's a yield, and we could figure out what is meant by this yield, and one could understand, okay, well, you know, the yield is the price, 94.79 times 1 plus whatever that rate, that's going to get them to 100. Of course, there's some sort of number of weeks that are in there. And so we can back out by asking students why one would pay 94.79 today for something that's worth 100 in a year, and they'll back out that there's some implied interest rate, which is the yield to maturity of 5.67%. So in our setup, we'll motivate that fundamental principle of how yield to maturities are calculated. So given that, the simulation, there'll be 52 weeks or trading periods in the year. Each week will take about 10 to 15 seconds. We want it just enough time so that students can see the prevailing yields and make a decision. All orders are fulfilled at the stated bid or ask price, as long as the trader has sufficient capital. And traders are allowed to take long or short positions equal to 2 times their equity. So as they start out with $1 million, they can take a position of up to $2 million. And there are no margin calls in this simulation to keep things simple. So an expanded view of the interface shows these price and yield graphs. So the price graph would look like this. This is an example. I've let the simulation go, in this case, to July 16th. And this is without any student trading. And so this pattern of ups and downs, peaks and valleys, is reflective of the randomized computerized traders in the market. So without any student interaction, the price will look like something like this. And so that will provide opportunities of high yields and low yields such that students will be motivated to trade. There's also a yield graph that's in there. We'll look at that later. And then a transaction log where each of the trades will be logged. Okay, so given that, let us set this up here. Oops, where's the mouse? Where's the mouse? Mouse?
Oh, here it is. Sorry.
Okay, great. All right. So the setup. So as you get the simulation, you'll be sent to a login screen, and this login screen will allow you to get into the administrative section of the simulation. I'm going to click on this simulation setup and the upload users. So as one does this, like I did with all of you, one approach to do it is to simply download the Excel spreadsheet that's here, and then you copy in the the email addresses, the first names and last names and passwords if you'd like. So that that's there. You save that and then upload that. So browse there and upload that and then submit that file. And that will end up giving you a list of users. Here we have all of our users. Get that to go down. So there's all the users, and we put them into one big team. In this case, there's only one team. If one would want to add users, you could simply do that by a manual entry too, or you just put in email addresses and names and a password if you'd like, and then add those individually. So setting it up is relatively simple. You can use their exact emails, or you can use dummy emails. So for example, one could put in anything. You know, I oftentimes use uva1.edu, uva2.edu as dummy login names for them, and then just distribute those to the students. So that's also certainly fine. The emails are simply used as login names for the students. So once that's set, we go to the game monitor, and there now I've sent each of you login names through the Forio system, and so invite each of you to go to the email address, which is this, forio.com/simulate/darden/bond-trader/simulation. So if you can go to that, maybe in that email that you got, that link was in there, I don't remember.
I'll look that up right now, Michael, and see if that is showing up.
Okay, there's one logged in, one success there. And when you log in, you should see a screen somewhat like this. Now with your students, so this is a common assignment sheet that I would hand out as part of the syllabus and getting them ready for the simulation. So prior to class day, they would have received 2 reading materials, this Introduction to Zero Coupon Risk-Free Bonds, that's simply an introduction to bond math and you know, what bonds are, to give them all the mechanics that they'll need. And then also the Bond Trader User Guide, which gives them a sense of what this simulation is about and what they'll be doing. And then there's a couple of assignment questions. This is some simple bond math questions to get them thinking about yield to maturity and applying the zero coupon risk-free bond note. And then this demo. So the demo, they should take advantage of that by going through that, and that'll provide an opportunity for them to actually do some trading prior to class and get comfortable with it so that we can use the class time.
I'm sorry,
Yes.
One question we're going to have is, which session do we want to select here today?
So it should be the webinar. Is there a webinar?
Yes, Darden webinar
February
18.
Darden webinar Feb 18. Thank you. Okay, I'm going to assume we're all.
We've got at least 8 folks logged in.
Okay. All right. So let's move forward here. So what I'm going to do is once they've logged in, the only other initiating thing you need to do on the admin side, you'll want to collect scenario A. So we have 3 different scenarios. I recommend starting with scenario A. I will also reset the simulation as a smart thing to do, just to make sure that all the parameters are reset. So I'll do that, scenario A, then I'll click on Save Settings. So we have Save Settings done. And then I start by advancing one period. So we'll advance to January 18. That will now populate all of the information so that students can begin making a trading decision. So here we have the December 19 bond. The yield to maturity on that's 5.67, meaning the ask is 9.479. And then cash, the yield on that is 4.41. We can see the price. Of course, it's not much to look at in the price graph because we just have the two data points there. So students will look at that and decide what trade to make. So they might say, well, the yield on December 19 looks pretty good. If I buy it at 9.479 and hold it to maturity, I'm getting at 5.67. That's better than 4.41 that I get this week. And it's better than the expected cash interest rate over the full year of 5.7% that we see up in the upper corner there. So, or hopefully you see that. I'll bring that down in case you don't. There you go. Okay. So, so let's say I'm going to submit a trade for, I don't know, 5,000 of December 19, and I'll submit buy.
You read my mind, Michael.
Okay. Go, Elliot. We'll see if Elliot can outdo me. We'll see. All right. So given that, I'm going to go ahead and advance another period here. I'll let it go through. And so we see what happened here. My guess is many of us submit buy orders there, and that's moved the price of December 19 up. So now the price is at 95.47, and the yield to maturity is now 4.99%. So barely larger than the 4.95 cash rate. And so I'm going to go ahead and just begin, let you trade, and we'll see where this goes. So let me click on here, and I'm going to click on just run. So the button run will allow it to run. So each week will take about 10 to 15 seconds. So away we go. Oftentimes I bring a little dinger bell, those little, bells like you'd find in a hotel lobby, and go ding ding, and away we go. And then the class goes wild as they're trying to figure out what to do. I find it to be, I'll let you trade here. Okay, so tremendous buying pressure there has pushed the price above 100. Okay, now we're back and forth. So we're getting dramatic back and forth as we work out pricing on this. So we can short. So I'm going to go ahead and short 10,000. Given that the yield is so low. While you're trading, I can monitor where people are. So I can see positions. And so far, Michael Schill is in the lead. How about that? Elliot's coming on now.
So Michael, as we're watching some gameplay here, tell us a little bit about what's going on in the classroom. What are students doing at this point? Or what's the interaction like?
Yeah, so as mentioned, I like to pair students up so they work in teams. So that'll provide, a lot of back and forth. The thing that we love about this is there's just tremendous energy as their competitive spirits peak, and they're initially pretty intimidated, or they can be intimidated, but then they quickly kind of figure things out and kind of get swept up by the excitement of all of it. So let me pause it right here. Okay, so if you look on my screen, you'll see I've got it sorted in order here. So Elliot here is on top with 5.64, and then me. And then we have all the way down here.
The zeros are probably folks that we had created accounts for, but couldn't make it to join us today.
Yep. We can see here the number of trades. So there's been a few trades, 9, 2, 4, 9. And then there's trade size here. And so we can monitor that. We're just trading the December 19, so December 20 over here is not active at this point. So oftentimes at this point, what I'll do, so I usually pause it in mid-April, and then I'll pull up some of these debriefing graphs. So for example, the price graph. So we'll look at that and we'll say, well, what do you observe from this price? And one thing that we'll observe is it's generally, except for this point here, trading below 100. Why is that? And we'll have a discussion about why that is. And essentially the time value of money concept will come out as students understand that one wouldn't want to buy it at 100 today for something that's going to be worth 100 today, because rather than that, it would make more sense to hold cash, because cash is generating an interest rate. So that cash yield is what's going to determine the opportunity cost for their money. And so they'll want to hold, they'll want to generate some yield. And so there'll be some required return, some discount rate that will be relevant to them as they're thinking about what price to buy the bond at. There's also be a discussion about how this is upward sloping. And generally, certainly as we wait longer and longer, it'll be upward sloping. And wonders how that changes over time as you become closer to maturity. We'll talk about, so this graphic here shows both the price and the yield to maturity. So the price is in blue and the yield to maturity in red. And ask about, well, why does it look like that? And the notion of it's a mirror image. And the observation that yield to maturity is the inverse, or inverse relationship to price, and why that is, and work out the math on that. You know, that's simply P equals 100 over 1 plus yield to maturity. And so that concept of the inverse relationship comes out nicely. And then we could look at this bond yield graphic, so they can see, you know, here we have in red is the price, is the yield on the bond, and green is the cash interest rate, and in blue is the expected cash interest rate. And one notices, well, what happens when the yield gets so low? Well, when the yield gets so low, nobody wants to hold the bond. Nobody wants to earn negative 1.5%. And so everyone will be selling. And that sales pressure will drop the price such that the yield increases. And that back and forth of competing for the best yield will discipline this yield to be approximately comparable to these alternative investment vehicles of the cash rate. So that'll get us there. And then we could, you know, query somebody and ask how they're doing. So for example, I've got Elliot here. I could look at him and pull up his performance here, and we see in green is the yield relative to the cash rate. So as it goes down, Elliot is selling, and as it goes up, Elliot is buying. And so we can see how he's responding to the relative rates between the two. So that'll give us, the idea is to generate discussion among the students and have those that have figured it out teach those that are still struggling, so that by the time we finish this debrief on April, everybody is kind of understanding how to go about doing it. And so then given that, I will restart. And so we'll go, you ready to trade again? And they'll all go, yeah. And I'll have maybe a candy bar or something that the winner's gonna get, and that'll be enough to create a frenzy. And I'll hit run and away we go. So you can all get back in. So I'm going to try to make a big trade here. So let's say 15,000. So I had a buy order there.
So Michael, can you
And
talk a little
boom.
bit more?
So that will go through the 20,000. If I try to do it again, so I don't have a lot of equity here now. I'm max that out, and then I'll get the rejected. So my order status there is rejected. That second 15,000 order did not go through, whereas the first one did go through. So that's, again, that 2 times equity is the limit on how much you can trade. Question?
Excellent. Michael, folks are wondering if you could talk a little bit more about the mechanics behind the simulation. When you've created a simulated market, how does that take the student's input and mesh it with what you've done behind the scenes?
Great. So so essentially what happens is each week all the orders get aggregated. So all the buy orders, all the sell orders, and those are coming from all the student traders as well as the computerized traders. So there's an equal amount of capital that's being traded by the computerized traders so that it balances the student trader effect. And so that balance is what moves the price. And we have an algorithm that is essentially the market maker, right? So an automated market maker that takes that order flow and adjusts the bid-ask prices to try to offset the imbalance in order flow. So it's meant to be, a simplified version of the way an actual market maker would respond. Let's check on how people are doing. It's fun to announce how people are doing as we go along, so we can kind of watch here in the active trader screen positions. It's common at the beginning that people will take relatively small positions. And so you want to encourage people to, as they see those that are doing well, to be aggressive in the positions they take. So it looks like Mr. Schill's killing it.
Yeah.
Mostly that's because of big positions, I think. There we go. And here we can look at prices. Again, we're seeing the prices continuing to drift up. I might note again, without the student traders, this pattern, kind of looks like this. There we're seeing a little bit of that, but essentially the front running of the student traders is going to, just diminishing those peaks and valleys as you buy, as you sell as prices get high and buy as prices get low. That will reduce that effect of those computerized traders. You can look again at the yields. We notice that these will continue to be disciplined anytime there's a yield that's particularly high. There'll be tremendous buying pressure, or a yield that's particularly slow. There'll be tremendous selling pressure. Again, that moves the price. Oops, so there's a high buy, high yield, so expecting lots of buys coming in right now, and seeing if that price will increase to reduce that yield. No, it's going up. We don't have any. We need some more traders in there. I'm going to buy. Oops, I can't buy. There we go.
Good.
So that responds it. So let me pause this here. So here we are in September, and we could chat again, or let it go through December, and at that point, talk through again these graphs and make sure that students understand this relationship between yields and prices, notion of required returns, how prices behave, and how market prices are formed, so that's essentially one would do oftentimes simulation A once or twice to make sure that those concepts have resonated with the students. And then in simulation B, jump to that here in the settings. So in scenario B, it's essentially the same setup, but there is news that comes out on central bank interest rates. So in this window, instead of just the market news pending, as things come along, let's say we come to April and there'll be an announcement that the central bank is going to increase the cash interest rate by 1%. And so I would pause the simulation that, allow students to kind of absorb, well, what does that mean? Cash interest rate is going to go up. So all of a sudden cash is more valuable and the yield, the bond is less valuable. And so oftentimes that'll result in an immediate sell of the bond and the yield will go up. And so the interesting thing about that is that response before the announcement will effectively capture the news associated with the information associated with the news, so that students are understanding how market efficiency works and how as soon as information comes out, prices respond in a way as traders offset the competing securities.
Michael, there's a question. Is there a lag from the time that market news comes out to when it affects? Is it the exact next week, or is it 2 weeks?
So generally it's announced a month in advance. So it's 4 trading periods in advance, and so we want that to be able to show that even though the interest rate hasn't changed yet, prices will reflect that information a month before or immediately when it comes out. And then in scenario C, the difference there is that we have another bond, both a 1-year bond and a 2-year bond. So the students are able to trade both of those bonds. And the notion there is we use that to motivate more advanced discussions of the yield curve. So one can kind of come up with that yield curve discussion in the initial, in scenario A, as you're trading off cash interest rates versus the 1-year rate, and this notion of expectations theory and how the 1-year rate reflects the expected return from all of the weekly cash interest rates. And the same logic will hold in scenario C, where you have the 2-year risk-free bond as well, and you trade over the 2 years. So so those are this other setting, or the other scenarios. Let me just show you a little bit these advanced settings. So the scenarios are all designed as we use them in the Darden first year program. But you can go in and adjust the scenarios to be your own settings. So this allows you to set the low and the high, the max and the min on the cash interest rates for year 1 and year 2. This has some computer trader bias, how much you want those swings up and down, whether you want it to be 1 year, 2 years, the time period, the student starting cash amount, the amount of the bid-ask spread, how responsive you want it to be to the order flow. So this is a market making parameter, and then interest rate changes. So this is where you're baking in that news that's coming out on the cash interest rate. So there's going to be a negative 0.75% interest rate news that comes in on week, whatever that is, week 9, and then another one of plus 1.5 in week 40 or whatever that is. So those are the different advanced settings. So let me just talk through any other questions, or
not yet.
Okay. So let me just talk through some resources that you have. As part of this, there is again, let me just show you, this is the Introduction to Zero Coupon Risk-Free Bond note that walks through the setup in terms of the math, bond math setup. There is this handout that talks about the user guide for the simulation, and that's something that students would get beforehand. And at the end of that, it has this link to the demo. So they would work through that demo on their own. That demo is not competitive, right? The prices don't change based on their their input, but it gives them an opportunity to see prices vary over time and to make trading decisions based on that. So that's designed to get them ready to go when the simulation is there. And then for the instructors, there is a whole user's manual that goes through, all the details of how the simulation works. So kind of the thinking behind it, learning objectives, the plan for the teaching plan. In this case, we do days 1 and 2, and then all the setup and the parameters that you might need as part of that. So those are the resources that are provided.
Excellent. Well, thank you, Michael. This has been very informative. We do have a group chat. If there are any more questions, please go ahead and submit those now. We can certainly follow up with folks on an individual basis as well. We really want to thank you for joining us today. We hope you enjoyed this demonstration of the bond trader. The price for this per student is $12.50. However, we are extending a special offer for anyone. We realize that some folks aren't even going to be able to use this until the fall term. So we'd like to extend a special 20% off for those of you who joined us today for your first course adoption of this. And you can contact us directly at sales@dardenbusinesspublishing.com to take advantage of that offer. Michael, thanks so much.
Hey, thank you, Elliot.
This is really wonderful. I'm glad that Darden students are enjoying this simulation. We hope that yours will as well.
Thank you.
Thanks.